Are you a trader or are you an investor? Most of us are investors. Most of us don't make our living by trading in the marketplace. We don't trade every day. We tend to have a portfolio that we have a set of stable stocks that we really don't trade at all. And then we may buy things occasionally and sell things occasionally. And that might be a couple of times a month, a couple of times a week. You're an investor. You look to the long term. You're mainly trading for your future and to hold the securities longer than a few moments. And I use that term exactly that way, a few moments. What makes an trader? A trader is somebody who trades for their own account, but trades in the marketplace every day in a substantial way. They don't intend to hold their securities a long time. And in fact, often if they have a long-term portfolio, they'll segregate it from the positions they're trading daily. But they'll actively trade in the marketplace. Now, what do I mean by actively? This is an area that you have to tread very carefully. And if you are thinking about claiming trader status on your tax return, this is a very serious conversation to have with your tax preparer. This is not something that you should take lightly or quickly. And if your tax preparer is not comfortable with this area of the tax code, because it's one of those things that's not commonly seen, then you need to find somebody to discuss it with that is knowledgeable in the area. The tax code is very clear in this area. You need to meet 3 conditions. However, it's the court cases that have come after these conditions that have really set the nature of what makes a trader versus an investor. So let's first talk about the 3 conditions. A trader must seek to profit from daily market movements in the prices of securities and not from dividends, interest, capital appreciation. So in other words, you're looking at the market's movements to make your money. The second point is that a trader's activity must be substantial. And the third point is that you carry on with continuity and regularity. So those sound pretty simple to me. You're looking for changes in the marketplace to make your money. You've got to trade substantially, in other words, with a significant amount, and you've got to be consistent. But it's the facts and circumstances that lay this out in a different way. The courts have really been bombarded with cases in this. And they want to say, what is the typical time period for your securities bought or sold? So are you holding them for a few hours? A lot of traders only do that. Or are you holding them for a few days? Or are you holding them 6, 8, 10, 12 months? Or 1, 2, 3, 4 years? A trader is generally in the I'm holding it for a few hours, a few days, a few weeks, not the longer period. That's the court cases that support this. What is substantial? Substantial is not a few $100s in the IRS's mind. So, substantial means that you have a pot of money, and it doesn't have to really be a lot with some of the trading things that you can do on margin and things, but a pot of money that you're constantly trading. So it's constantly in and out of the marketplace. And as it grows, that growth is constantly in and out of the marketplace. And the third criteria is what makes consistency or continuity and regularity. Is it 1 or 2 trades a week? No. Is it 1 or 2 trades a day? Most likely not. Is it 10 trades a day? That's a little grayer, but the courts have said probably not. Is it 100 trades in the first month of the year and none the rest? Absolutely not. The courts have ruled on that. So this is an area where the rules seem simple, but it's the court cases that determine how the rules apply. So when I say that you need to consult with your tax advisor and find somebody that's knowledgeable in this area, If they just read the conditions, almost everybody would meet them if you make 4 or 5 trades a week. But let me tell you, that does not make a trader in the IRS's mind. So be very, very careful here. The IRS has a topic on their website, irs.gov, and it's IRS topic 429. And obviously, that's a free website, a free topic to pull up, and it has a lot of information on it in this area. And I strongly suggest you read this if you're even considering this before you start doing it. Now, why would you want to do it? There's tax advantages. You now have taken your trading activity, put it on a Schedule C like business, and you are now allowed to deduct all those expenses we talked about. Your advisory fee, your investment fees, your fees from other things within your brokerage account, your account fees. All those things become deductible as business expenses. So that's a good thing. You also have the option to make an election to market and recognize your gains as they happen. That's an election. You must make it in writing with the IRS by April 15th of the year you intend it for. So if we are in 2019, you've already missed the date to make the election because it is May at this point. But you could make the election for 2020. What does mark-to-market do for you? It means daily. You mark your portfolio to the market price, recognize any gain or loss. Recognize any gain or loss from that previous day, the next day. But remember, it's a written election. This is also an area where we talked earlier about Section 199A, the new part of the tax code that allows the 20% deduction of business income from taxes. This area qualifies for that. So finally, I want to talk about audit considerations because I would be doing you a disservice if I didn't mention this. There's no way that I can discourage you from making yourself a trader on your tax return. But it's something that I want to make sure that you understand is a big step and opens you up probably to an audit by the IRS. The IRS views this area as a place for money to be captured and taxes to be gained. So with their limited audit resources nowadays, this is an area that they're going to hit first. So it's one of the things that you need to do if you decide to become a trader and decide to take a trader position on your tax return is to, and you can't say this enough, document. Make sure you keep really good records. Make sure you know what you're doing. Almost keep a time log of the time you spend at this activity. Because believe it or not, that's something they're going to want to know. If you only spend an hour a day trading in the marketplace, you're not going to make it because the courts have already ruled against that. But if you spend 5 or 6 almost every day, then they're going to be all right with it. So this is an area that you certainly want to have a knowledgeable tax advisor on your team and be very careful and take it as a job, treat it professionally, not as a hobby. Good luck to you if you decide this, and make sure you meet the criteria. We've talked a lot about taxes at a very high level. We haven't really delved into a lot of the nitty-gritty details that are in the tax code. The tax code currently is a set of books, if you buy the books. Most of us do it online nowadays, but it's 9 books, and they take about this much space on a shelf. And so obviously in these short lessons, we're not able to talk or cover in detail everything that you should know about preparing your taxes or even treating your investments on your tax return. It's very important to have a trusted tax advisor, have good conversations with them, and not hesitate to ask them questions. If they're not willing to do that with you, and especially if you're taking a position as a trader, then you need a new tax advisor. Your tax advisor is a little bit like your doctor. If you're not friends with them and you're afraid to talk to them, they're not going to be able to do their best work for you.